What if you could pull $5,000 every single month from one investment and never run out of money? Not from crypto, not from day trading, not from some guru's private course, just the S&P 500, one index, exposed to every crash, every recession, every crisis in modern history, and it still kept climbing. Today, I'm showing you the exact number you need, exactly how the withdrawals work, and how to get there, even if your savings right now make you want to close the app. Let's start with the math, because the math is what makes this real. $5,000 a month is $60,000 a year. That's the target. Now, the safest, most battle-tested way to pull income from a portfolio without draining it is something called the 4% rule. It comes from a famous piece of research called the Trinity Study, and here's what it found. If you withdraw 4% of your portfolio in year one, then adjust that amount for inflation each year after, your money survives for 30 years or more in almost every historical scenario they tested. So you flip the formula. $60,000 divided by 4% equals $1.5 million. That's the number, $1.5 million invested in the S&P 500, and you can pull $5,000 a month with confidence. Now, before you click away thinking that number is impossible, stay with me, because what I'm about to break down changes the way you see that number entirely. But first, there's something most people get dangerously wrong about withdrawing from the S&P 500, and getting it wrong could mean running out of money a full decade too early. I'll come back to that. First, let me show you why the S&P 500 specifically.
The S&P 500 is a list of the 500 largest, most profitable public companies in America. Apple, Microsoft, Amazon, JP Morgan, Johnson & Johnson, all of them bundled into one index. When you buy an S&P 500 index fund, through any brokerage, doesn't matter which one, you own a tiny slice of all 500. Now here's the part that matters. Since 1957, the S&P 500 has returned an average of roughly 10% per year, including dividends. Some years it's up 25%. Some years it drops 35%. But zoom out over any 20-year window in history, it has never lost money. Not once. Through world wars, oil crises, dot-com crashes, a global pandemic, every single 20-year stretch ended positive. And the cost to own it? An S&P 500 index fund charges you almost nothing. We're talking expense ratios as low as 0.01 to 0.03%. That's less than $3 a year on a $10,000 investment. No financial advisor fees, no hidden charges, no one picking stocks for you and getting it wrong. This is the closest thing to a cheat code that exists in personal finance. But it only works if you understand how the timeline plays out. Most people hear $1.5 million and immediately disqualify themselves. They say, that's not for people like me. And honestly, that one belief is the most expensive thought you'll ever have. Because $1.5 million is not some lump sum you need to find under a mattress. It's a destination, and compounding does most of the driving. Here's what that looks like in real numbers. If you invest $500 a month into an S&P 500 index fund starting today, and the market returns an average of 10% per year, in 30 years, you'll have roughly $1.13 million. You only put in $180,000 of your own money. The market handed you over $950,000 for free. Bump that to $750 a month, you cross $1.5 million in about 28 years. At $1,000 a month, 25 years. At $1,500 a month, 22 years. The gap between impossible and done is just a few $100s a month and the patience to not touch it. Okay, but what does $5,000 a month actually feel like? Is it enough to live on? Because that number means nothing if it doesn't translate into a life you'd actually want.
The average American household spends about $6,440 a month. But strip out the car payment on a car you're still financing, the subscriptions you forgot about, the lifestyle inflation that crept in without your permission, and $5,000 a month becomes very livable, especially if your house is paid off, especially if you carry no debt. That $5,000 covers groceries, utilities, insurance, gas, and still leaves room for travel and actually enjoying your life.
And here's what most people completely miss about the 4% rule. In the majority of historical scenarios, your portfolio doesn't just survive the withdrawals, it actually grows. Meaning after 30 years of pulling $5,000 every single month, you could end up with more money than you started with. Let that sink in. Now remember, I said people get something dangerously wrong about withdrawing from the S&P 500. Here's what it is, and this is the part that actually protects your money.
The mistake is this. People think they'll just keep 100% of their money in the S&P 500 and start pulling cash. But what happens when the market drops 30% in a year and you still need your $5,000 that month? You're forced to sell low. And selling low during a crash is the fastest way to destroy a retirement portfolio. So here's what smart investors do instead. As you approach your $1.5 million target, you start shifting a portion of your portfolio into bonds or a bond index fund. A common split is 80% S&P 500, 20% bonds during your early withdrawal years. The bonds act as a cushion. When the stock market crashes, you pull from the bond portion instead, giving your stocks time to recover. Then, as you age, you gradually shift more toward bonds for stability. Because here's the real truth. The biggest risk isn't the S&P 500 crashing. The S&P 500 has recovered from every single crash in history. The biggest risk is you panicking during a crash and selling everything at the bottom. That's why the boring strategy wins. The S&P 500 doesn't need you to watch it. It doesn't need you to time the market. It just needs you to not quit. So here's the play. Open a brokerage account, any major one. It takes 10 minutes. Put your first 100, 500, whatever you can, into an S&P 500 index fund. Set up automatic monthly investments. Then don't touch it. Let dividends reinvest. Let compounding stack. Let time become your silent business partner. In 20 to 30 years, you'll be the person pulling $5,000 a month, while everyone else is still wondering whether they should start investing. The target is $1.5 million, but the amount you need to start? Whatever's in your pocket right now. The distance between those two numbers is filled with one thing: the decision you make today.